Most of you might have already seen countless videos on chart patterns and how to trade them, but the truth is, very few actually explain why you should trade these patterns in the first place. Why do these chart patterns work in the market? And most importantly, how can you identify a valid pattern versus an invalid one? That's exactly why this is going to be the most comprehensive course on chart patterns available for free. While many traders charge high prices for incomplete courses on this topic, here you'll get everything step by step, completely free for educational purposes only. This will be a 3-part series covering chart patterns in depth. And since creating these videos takes a lot of effort and time to make them clear and practical, I have just one request. Let's aim for at least 1,000 likes on this video. So make sure you share this with your trading friends. And if you're new here, don't forget to subscribe and turn on the bell icon so you never miss an update from this series. All right, let's begin. Charts basically represent the supply and demand of the market. They are the reason why trends move in a certain way on the trading chart, which eventually leads to the formation of patterns. Now, when a trader looks at a stock or index price chart, at first it may appear like random movement, but hidden inside these movements are chart patterns, which are often not visible to beginners. Chart patterns are simply geometric shapes that appear within price data. They help traders understand price action and also predict the possible future direction of the market. However, it's important to note, chart patterns never guarantee market movement. They are not a shortcut to success. Instead, they should always be used together with other forms of market analysis. Generally, chart patterns fall into 3 main categories: continuation patterns, reversal patterns, and neutral patterns. In this series, we'll cover why and how these patterns form, how to identify whether a pattern is valid or invalid, and most importantly, how to trade them by setting proper entry, stop loss, and targets. We'll begin with continuation patterns. Now, if you don't know what a continuation pattern is, let me explain. As the name suggests, continuation patterns indicate that the existing market trend is likely to continue. In simple terms, once a pattern is formed, the market usually keeps moving in the same direction it was moving before. Most continuation patterns are formed during a phase of consolidation, almost like the market is taking a short break. Think of it as if the market is tired, taking a tea break, and then coming back refreshed to continue its work in the same direction. To bring more clarity, let me explain something first. Continuation chart patterns are mainly divided into 5 types. The first is flag patterns, the second is pennant patterns, the third is triangles, the fourth is rectangles, and finally, the fifth is the cup and handle. Once we cover these 5, we'll complete the entire continuation pattern section. In today's video, we're going to dive deep into the flag pattern. But before we move ahead, I want to clear up one of the biggest doubts traders usually have, and that is about time frames. The truth is, all the patterns I'll explain in this series can appear across intraday, swing, and even positional time frames. The only difference is that on higher time frames, these patterns usually work much more effectively because they take more time to form, which makes them stronger and more reliable. So depending on your own trading style, you can choose the time frame that suits you best. Let's dive into the bullish flag pattern in detail. As the name suggests, a bullish flag forms during a bullish trend. It usually starts after a strong, almost vertical upward move. Then, the market stabilizes and creates parallel tops and bottoms, forming a temporary bearish correction. This correction often acts as an important support and resistance zone. Now, every flag pattern has 3 main parts that define its structure. To identify a bull flag correctly, you need to keep these points in mind. How to find a flag pattern on the chart. The first step is to look for a strong preceding uptrend. Since a bullish flag only forms during an uptrend, you'll notice candles with larger bullish ranges, often closing near their highs. This indicates strong buying pressure and clear dominance of buyers in the market. After such a sharp move, the market usually takes a pause. This pause is nothing but profit booking, where early buyers lock in some gains. During this phase, the market pulls back, and this pullback is where the flag begins to form. Unlike a normal pullback, the bullish flag shows a shallow retracement. The candles inside the flag are relatively smaller compared to the initial strong bullish move. This structure tells us that sellers are struggling to push the price down, while buyers are still holding control. In short, a bullish flag signals that the market is simply taking a breath before continuing the strong uptrend. If you see a steep pullback after a large range candle, it may not always be a proper bull flag pattern. Normally, the retracement should not fall below the 38.2% level of the original move, as shown by Fibonacci. If it respects that zone, we can consider it a valid bullish flag. But if the retracement goes deeper than 50%, then it loses the flag structure and should not be traded as a bullish flag. The tighter the range, the higher the probability of a breakout to the upside. So now that we understand how to identify a bullish flag and how to filter valid versus invalid setups, let's discuss how to actually trade the flag pattern. When it comes to entries, because this is a bullish continuation pattern, we only focus on a breakout of the resistance trend line. Once the price breaks above the resistance trend line, you can plan a long entry. You can either enter immediately on the breakout candle or wait for the candle to close and enter with the next one. Another method is to wait for price to pull back and retest the broken resistance level. If the market respects that level and starts pushing higher again, that can give you a more conservative long entry. Now, which entry method is better? The truth is, there is no one best way. If you enter directly on the breakout, sometimes it might turn into a false breakout, but if it's a real breakout, that's usually the most profitable entry point. On the other hand, waiting for a retest helps you avoid false breakouts, but it can also mean entering at a higher price or even missing the move entirely if the trend is very strong. That's why the best approach is to choose the method that fits your style, test it across a large number of trades, and gain confidence through practice. You can also confirm breakout validity by using volume or any reliable indicator. A higher than average volume usually validates a breakout because it reflects strong market participation, while a low volume breakout has a much higher chance of failure. Momentum indicators like MACD or RSI can also help you. I've already explained RSI in detail from basics to advanced, and you can check that video by clicking the I button. Using these tools makes it easier to identify real breakouts. Now let's focus on how to set a proper stop loss when trading a bullish flag pattern. Many traders place stop losses at obvious levels like support, resistance, or swing highs and lows. But this approach often gets your stop hunted because those levels are too obvious and smart money targets them. So, what's the right way? Your stop loss should always be at a level where, if price reaches it, your trade setup is invalidated. For a bullish flag, the setup becomes invalid if the price breaks below the bottom trend line or closes under it. That's why your stop loss must be placed below this support level. However, long wicks can still hit your stop loss. To add extra protection, you can use the ATR indicator to mark your stop loss more safely. Now, let's understand how to define your profit target. There are several approaches that traders use, but one of the most common methods is based on the length of the flagpole. First, measure the length of the flagpole from the bottom support level to the top. You can use tools like the data range or measuring tool on TradingView. Next, project this same length upward from the breakout point of the resistance trend line. That projected level will be your profit target. A bullish flag pattern can appear in four main scenarios. Number 1, after a resistance breakout, during the first pullback, a bull flag forms. Number 2, in an ongoing uptrend, where the flag pattern signals trend continuation. Number 3, inside a ranging market, where a bull flag develops within the range. And number 4, in a downtrend, where a bullish flag may form as a signal of a possible trend reversal. Remember, in all these scenarios, the entry, stop loss, and target strategy remain the same. A bear flag pattern is basically the opposite of the bull flag pattern. Traders also call it the inverted flag pattern. Like the bull flag, this is also a continuation chart pattern, but instead of signaling strength, it indicates the possibility of a further downward move in the market. I won't go into too much detail here because it could make the video longer, but if you have clearly understood how to trade a bull flag, then trading a bear flag will be much easier for you. You just need to flip the bull flag concept by 180 degrees. Now let's break down how to identify a bear flag pattern. 1. First, look for a strong move to the downside. This means the bearish candles are larger than usual and closing near their lows. This initial sharp decline forms the flagpole. 2. After the strong bearish move, the market takes a pause. This pause appears as a pullback or a small consolidation against the main trend. During this phase, the candles are generally smaller in range compared to the initial drop, and they often move in a tight channel. 3. The tighter the pullback, the stronger the breakout potential. A clean, narrow pullback increases the chances of another bearish continuation once the pattern breaks downwards. Important rule for a valid bear flag. The pullback should not retrace more than 50% of the flagpole length. If the retracement goes beyond that, the pattern loses validity and should not be considered a bear flag. The entry criteria for a bear flag are quite similar to other continuation setups. The only difference is that here, we are only looking for short opportunities. Since this is a bearish continuation pattern, once the price breaks below the support trend line, you can enter a sell position. However, there's always a risk of fakeouts. That's why it's safer to wait until the breakdown candle closes and then look to enter below its low. But keep this in mind, if the breakout candle is too large, your entry will be at a much lower price, which negatively impacts your risk-to-reward ratio. In that case, another option is to wait for a pullback or a retest of the broken trend line before entering short. One important thing to understand: in a strong downtrend, price often does not pull back enough, and you may miss your entry. This is why you must define your own entry strategy and practice it across a large number of trades. To confirm whether a breakout is valid, always use momentum indicators like volume, MACD, or RSI. When it comes to protecting your position, place your stop loss at a level that invalidates your setup. In this case, if price breaks above the resistance trend line, the bear flag is no longer valid. That's why it's better to keep your stop loss just above the resistance line. Now, for target setting, there are two common methods. 1. Price projection method. Measure the length of the flagpole and project it downward from the breakdown point. 2. Trailing stop method. Use moving averages, such as the 20 or 50 period EMA, or tools like the chandelier stop, to ride the trend and capture bigger moves during strong breakdowns. Combining both these methods can be extremely powerful, allowing you to maximize profits while still protecting your gains. Finally, the most important part: where to find these patterns. Bear flags typically appear during strong trending markets, especially after sharp impulsive moves. Training your eyes to spot them early and practicing across different charts is the key to mastering this setup. A bear flag usually forms in a strong downtrend. The initial sharp move down creates the flagpole, while the short-term pullback forms the flag consolidation. Once the price breaks below this consolidation zone, you can look for a short entry based on your preferred trading criteria. To confirm the market trend, traders often use moving averages. The choice depends on your style. For example, 20 to 50 period averages for short-term moves, and 50 to 200 period averages for longer-term trends. The key is that price should stay below the moving averages, and the slope should also be pointing downward. Bear flags can also appear in ranging markets, especially near a strong support level. Sometimes, the consolidation near support takes the shape of a flag. Just make sure the breakout is confirmed before entering. Once price breaks that build-up along with the support, it often provides a valid short opportunity. In certain cases, a bear flag can even form during an uptrend, specifically when the bullish structure fails and transitions into a bearish continuation. So today, we've broken down the flag pattern, how it forms, and where you can find it. In the next part of this series, we'll dive deeper into the pennant pattern. Until then, stay connected by subscribing to the channel, and if you learned something new today, don't forget to like this video. See you in the next one.